SBG Securities Limited is, as you have said, a player in the capital markets, but we are essentially a securities broker with a license on the Nairobi, Rwanda and Uganda securities exchanges. We are part of the CFC Stanbic group here in Kenya. CFC Stanbic Holdings is a listed company on the Nairobi Stock Exchange that owns CFC Stanbic Bank as well as SBG Securities. So we're part of that group, and as you've mentioned, yes, we are a top broker on the Nairobi Securities Exchange as well as in Rwanda and Uganda. Look, I think in the short term there will be some pain with the capping of rates because it has disrupted the way banks have been doing business for close to 17 years since the market was liberalized. So in the short term there's going to be some pain, people are going to have to readjust, but I think the fundamentals for this economy and the fundamentals, especially for the finance sector, have not changed that materially. And I think in the medium to long term, assuming that the bill stays in place, that the Act remains in place, that it's not repealed, I think in the long term we shall see probably things settle down and a growth of the other sectors apart from, or other industries within the financial sector coming up to take the slack, or that will occur when credit from banks starts to be applied a little bit more strictly. Yeah, okay, so the market has seen some weakness I would say, in the last 12 months. But to be honest, towards the end of 2014 and moving into early 2015, key or close observers of the market realized that the market was getting overheated and there was going to be, there were signs of a correction happening. And that came through in mid-2015, mainly driven by a spike in interest rates that happened to try and stabilize the currency. So the market re-rated, and we're still seeing that weakness, which will probably pertain into 2017, maybe towards the general elections in August. So this is something that keen observers of the market had anticipated. Markets always move in cycles. I think that's a point I'm trying to make. We had a boom in 2013, 2014. It needed to cool down because the exuberance was getting a little bit out of hand, and that's how the markets operate. At this point in time, if you ask any analyst or any observer of our market, it is actually an entry point. It is fairly cheap. I think what is stopping activity really picking up is other looming issues like the elections next year and maybe how the rate capping is going to play out. But I think once these things settle, everybody realizes that it is time to enter the market now. Granted, there might be people who are holding some unrealized losses, like you mentioned, the insurance sector, the fund managers, but that's just part of the cycle. When the market starts to pick up, they'll be back in the money. So they're underwater right now, but that does not mean that the market is not viable or is not ready for investment at this point in time. Yeah. I think the market is attractive, but it's not optimal, it's not ideal. So I agree with you, yes, there is room to increase the number of listings. There is need to increase the number of listings. There is need to increase liquidity. But having said that, even just with the top 10, top 15 securities listed on the NSE, we see good activity. In good years, there's enough activity and enough opportunity for all investors. Granted, the market has been slow to bring listings. I think this is a debate that we've had for close to 15 years. And I think personally, and these are just my personal comments, one of the reasons why we've struggled to get companies coming to the market to raise capital is because it's been easy to access capital from other sources. The banks have been a key player in that market, lending to SMEs, even those that might be fairly risky, whereas risky capital should really be accessed through the capital markets, where the people who can analyze that risk and take that risk for a return. So I think with the capping of interest rates, I think it's intuitive to most observers that there's going to be, credit to the SME sector is going to dry up. It's not going to be as business as usual. And I think eventually what's going to happen is maybe some of these SMEs will start to look at other avenues for raising capital as opposed to just bank debt. And I think that's where the capital markets will come in. So there's a need to think of new products for these SMEs or for that sector. There's a need to bring these clients up or these corporates up. I mean, the reason why the GEMS market was set up by the NSC and the Capital Markets Authority was really to attract this sector or that segment of the economy. And I think it's something that we shall see starting to come through in the medium term once people realize that it's not as easy to get bank credit as it used to be. But I think if you look closely at those reports, they are talking about repeat borrowers or people topping up. So these are borrowers who already existed and were already qualified. I think for the new people coming to the market is where they might be. Yeah, that's where the problem will be. And also on the SME sector, I think that is, these are risky businesses. We're told, I don't know the statistics, is it 3 out of 10 SMEs survive beyond 2 years? That's a risky sector. And with the kind of margins that banks are going to have to live with going forward, I think it'll be difficult for them to lend to that sector. So I think these are early days. Yeah, people are all theorizing and everybody has an idea. I think we'll really know what's happening in the next 12 to 18 months, especially when we see maybe a full cycle of reporting of how the banks are managing the new environment. On the derivatives market, there's a view that, and you see there's many types of derivatives you can set up. I think what the exchange is trying to bring is, futures contracts. And futures contracts are not necessarily settled by physical underlying assets. So they're just cash settled. So it's almost what we've been doing in the cash equities market, only we'll be dealing with synthetic products. So in that perspective, I think it is viable because if I'm buying a futures on the, say for example, if I'm buying a futures on a currency pair, I don't have to have stock of the currency that I'm hedging on to be able to deliver. If it's on agricultural commodities, I don't actually have to have the physical commodity. I will just deliver based on a cash settlement. So in that perspective, I think that for markets like ours, which are small and still nascent, it is a viable way to develop a derivatives market. But on the other hand, especially when you look at the equities market and the fixed income market, they're still fairly illiquid, as we discussed earlier. And so to have a really, really vibrant overlying market, if I can call it that, the underlying must also be liquid, must also be, fairly active to support the overlying market. And I think that's probably where we will struggle. I don't think it's necessarily been suspended. What we understand, I mean, we are one of the, as a group, we've been talking with the NSC about the market. I don't think it's necessarily been suspended. I think we're just trying to make sure that we get everything right before we actually launch. But there will be challenges, and these markets don't pick up immediately. But when they do, they can be fairly viable. Okay, I think the whole Kenyan corporate sector tends to slow down when there's a looming election. But when you look at our market, it is currently almost 70% traded by foreign investors. The reading we have of many of our clients is that the 2013 election, which was contested in the Supreme Court, was a very smooth election in that, the Supreme Court made a ruling and we moved on. So from that perspective, the foreign clients are not necessarily as jittery as the local clients. Yeah. The local clients have a different view. They've been here 20, 30, 50 years. So they know how things can easily probably get out of hand. But I think personally that we might see a bump up in the market even before the elections. If there's certainty towards the elections, if there's certainty that institutions will work, that business as usual will not be so interrupted, at these current prices and valuations, I think you could see people start to move ahead of the market, of the general sentiment in the view that they expect things to pick up once the elections are done and dusted. Yeah, unfortunately, those markets tend to follow Kenya. They are a lot smaller than we are, a lot more illiquid than Kenya is, and they tend to follow what happens in this part of the world. Let's put it this way. I've said the market is being driven by foreign investors. So when a foreigner is looking at this region, he cannot isolate Rwanda or Uganda. They'll look at it as a region. And if Kenya is not doing well, they'll tend to, they can't focus all their resources just on Rwanda, which is a small market, or Uganda. So they have to look at it as a whole, sometimes even across the whole of sub-Saharan Africa. So even what happens in Nigeria affects what's happening in Kenya. If you have a foreign investor that is based in London, they'll look at sub-Saharan Africa as one destination. So if they're not doing much in Nigeria, they are likely to be doing much in East Africa, if they're not doing much in West Africa. And the thing is that if they're not then investing in say, in West Africa or Nigeria and are putting all their money in Kenya, they're going to become overweight in Kenya quite quickly. So you need Nigeria to pick up for them to be able to rebalance. Yeah. So actually what happened towards the end of last year is that we were significantly overweight for most of the foreign institutions, and so they started slowing down. And we see that continuing into 2016.